So guys, today I am giving an update on my debit spread portfolio. I'm going to be showing all of my positions, the strike prices, the expiration dates, and it all visualized on a chart. So let's dive straight into this. Okay guys, you can see here that our profit loss open is $79. And on all of these debit spreads diversified through these companies, we are up a total of $171 off of our $1,000 initial investment. And you could see here on our TLT plays, we'll get more into this play later, we are down $92 off of our $300 investment. So we are up overall, and let's dive into some of my plays. First, let's cover AMD here. So this horizontal red line you can see right here is our break even, and this yellow line is our expiration date. So we can go ahead and take a look at AMD. We see we have a call debit spread between the 74 call and 73.5 call. So we paid a total of $25 for this singular contract, and our max profit is $25, say 100% return if AMD is at or above 74 by July 2nd. So you can see here, if it's at or above that $74 mark by July 2nd, we will make $25 off of our $25 investment. So I'd say that's pretty good. That's a pretty good deal. Next, let's take a look at Carnival Cruise Line. You can see here that it's still recovering from its COVID crash. So on Carnival, we have a spread between the $25 call and the $27.5 call. So this is a $2.5 spread, and we paid pretty much half the value of the width since it was an at-the-money contract at the time we bought it. So we are looking for a 100% return on our investment if Carnival Cruise Line is at or above 75.5. So you could see here that this horizontal yellow line is 75.5, and this vertical line is the expiration date, and this red line going upwards is the current trend line for Carnival. So as you can see, if Carnival keeps bouncing on this, we should be at or above 75.5 by July 2nd or July 16th. So this is looking really good for a quick 100% return. We'd put in a total of about $300 into this, so we should be getting about $300 out of it by the expiration date. Next up, we have the Dow Jones Index. So the reason I chose the Dow over the NASDAQ currently is because from the Dow's pre-COVID high, it's up 16%, and from the NASDAQ COVID high, it is up 40%. So we can go ahead and we can see it's up 40%. A QQQ debit spread with the same expiration date. And the reason I did this was because I have to have some tech exposure, but the difference is I only bought one contract with a width of 1, so I spent about $50 on the QQQ contract versus $150 as I did with the Dow. So my max loss is a lot lower on this one because I did see it as a riskier position. But as you can see coming up here on the NASDAQ, our break even here is $321 and our expiration date August 20th. So if it just continues on upwards trend line, we should be at or above $320 by the expiration date, giving us our 100% return. Next up is United Airlines Holdings. So this is another recovery play just as Carnival is. As you could see, break even is 54. Our expiration date is June 20. What was it? This is our shortest expiry one. June 25th. We have 26 days on it. And yeah, if it just follows this trend line, we should be above 54 by the expiration date, which would net us 100% return on our $50 investment. So very, very great. We have X here. This is the United States Steel stock X. So you could see here it's following this upward trend line here. It just bounced off of it, and I entered the position there. So you could see on our X debit spread, I only spent $50 on it for one debit spread with a width of 1. And we have it for August 20th. So if it just continues this trend line, then we should be well above the price by the expiration date. And you're probably thinking, why'd you get such a long expiration date? Well, this thing is very, very volatile, so I wanted to just be safe with it. That's why I only put in $50. XOM gas station, we have it for July 2nd, and it is a 0.5 spread. So we spent $25 on 2 contracts, total of $50 for a $50 total return, 100%. We can go ahead and take a look at XOM here. XOM, our break even is 59, and our expiration date is July 1st. So this thing is kind of breaking out of this trend line it was following, so we're going to see what happens. Only $50 in it. And lastly, we have Microsoft. So let's pull up Microsoft. We can see our expiration date is August 20th. Our break even is $250, and it is following this upwards trend line. So if it stays on this trend line, we should be at or above $250 by the expiration date. My final play I'm going to cover is the TLT play I have going on. And because I personally believe that interest rates are going to continue to increase, inflation is going to continue to increase prices of things, I believe that the 20-year Treasury will continue to sell off as it is. So let's go ahead and take a look at that. So here we are going to take a look at TLT here. So taking a look here, we can see this very, very, very valid trend line sloping down. We could see that it found its previous resistance back here, and it has been following a downward support until in February it had broken this, and we saw all that madness in tech and growth back in February. So we can see lately it's been chilling out, but I do think it will continue following this very valid trend line all the way down to the support zone, and it will eventually break downwards. My positions, it started out with this 125 put that I bought for $100, expires August 20th. And we have the 122 put I bought for $63, expires the same expiration date. So this one's down $23, and this one is down $46. So we're pretty much down like 50% on both of those calls, but we didn't put a lot into it, so I'm not too worried about that. What I do have to back it up is this 131, 132 put debit spread. We have 3 of them that we bought for $60 each. So that gives us a $300 total profit from a $60 total investment. And I have this for October 15th. So by October 15th, I think it'll be below 131, which I think is totally reasonable and possible, which would give us a great return by October. Yeah, I think that's possible. Be below 131, even though 131 is a very solid support level. But we have this 137, 138 put debit spread. We have 2 of these that I bought for $50, so $100 in, $100 max profit. It was below 137 by August, which I definitely think is possible. So we do have these put debit spreads that are backing everything up, and I do think that these will help me if my long calls, out of the money calls, don't make it to their strike price by the expiration date. I have those debit spreads to help me make some profits and recover from those losses. So I think overall I will be up on this position, worst case scenario, but we're just going to find out what happens. Overall, we only have about $230 in versus $1,000 in diversified through all these companies. So even if this play totally goes to shit, I have all of these to back it up, so I'm completely good. Alright guys, so that's the end of my video. I hope you guys enjoyed looking at my portfolio management skills. This is basically what I want to do for the rest of my life, is just manage this portfolio and continue to grow it over time. So that's exactly what I'm doing. I haven't been placing many orders because I recently found out that I pay a lot of fucking commission fees. We could see here that total commissions and fees year to date, $829, because I was placing an order a fucking day. You could see here that 111 days back, we have filled 230 orders, which is just absurd. So I haven't been doing much. I'm just letting my portfolio continue to grow over time and continue to sharpen my mind. So hope you guys enjoyed that video. Hope you learned something. Drop a like, drop a comment, and subscribe for the YouTube algorithm to show more people my videos. Thanks for watching. Goodbye.